Thank you all for taking the time to come, and welcome to Whitbread's annual results presentation for the year ended the end of February. For those of you on our webcast too, thank you for joining us. I hope you all agree with me that this is another very good set of results. Once again, strong cash flow has funded the necessary capital investment for our growth engines, Premier Inn and Costa, to increase their share of the market and deliver outstanding top-line growth. With restaurant sales also doing better, particularly in the second half, underlying profit for Whitbread as a whole was up 16.5%, leading to underlying EPS and a proposed dividend increase of around 20%. This is a truly great result for the company and for its shareholders. Meanwhile, lease and pension deficit adjusted net debt at about 2.3 billion remains at a prudent level relative to our target of below 3.5 times EBITDA. The strength of our leading brands, our investment in real estate, product, marketing and technology, and the extraordinary focus on customer service of our 43,000 team members continue to position us well relative to our competition, and I believe bode well for future growth. Thank you. Nicholas and Andy will now take you through the results.
Well, good morning and welcome. Before I begin, let me just introduce the members of the executive team who are here today. We've got Patrick Dempsey, who leads Whitbread Hotels and Restaurants, Chris Rogers, the head of Costa, Louise Smalley, our HR director, Paul Flame, the head of our restaurant business, and Simon Barrett, our Wise General Counsel. I'm pleased to report another year of strong double-digit growth, with our revenues up 13%, driven by continuing network expansion and like-for-like sales growth of 4.2%. This drove a 16% increase in our underlying pre-tax profit to nearly £412 million, which, with the benefit of a lower tax charge, drove a 20% increase in our earnings per share. We increased our return on capital by 1.4 percentage points to 15.3%, which helped to drive our cash flow from operations up by 14% to £601 million. This strong profit growth, together with strong cash flow, has allowed the board to recommend a full-year dividend increase of 20% to fund and also to fund capital reinvestment in the business of £306 million. We had a strong finish to the financial year, better than expected, boosted by favourable weather comparatives and successful Christmas and New Year trading campaigns. This particularly helped our restaurant sales, which, together with less promotional discounting, translated into a good profit performance. We also saw good room rate growth, which drops straight through to the bottom line. And it's absolutely no coincidence that our record financial performance has been matched by record guest scores and record employee engagement, once again. And I'd like to compliment our business leadership teams as well as our customer-facing teams for delivering such a strong customer performance and excellent operational results. We remain on track to deliver our 2016 and 2018 growth milestones for both Premier Inn and Costa. So let me hand over to Nicholas now, who will talk you through the results in more detail.
Good morning, everyone. Underlying profit was up 16.5% to 411.8 million, with a particularly strong finish to the year. Basic underlying earnings per share grew 20.1%, benefiting from the lower corporation tax rate, which I will come back to later. The strong overall results and the confidence we have in our growth plans has led the board to recommend a total dividend increase for the year in line with the earnings growth, up 19.9% to 68.8 pence. Revenue was up 13% to 2.3 billion, with underlying operating profit up 14.2% to 430.7 million. Interest costs reduced by 4.7 million to 18.9 million due to the maturity of a number of fixed-rate swaps at the end of 2012, and the strong cash flow in the year, reducing our average net debt. Looking at profits from operations, We had a good performance in both businesses, with hotels and restaurants profits up 11.2% and Costa up 21.9%. Hotel and restaurants profits in the UK and Ireland was up 10.9% to 354 million. International hotel losses were relatively flat at 6 million, as we made good progress in the Middle East and continued the setup of our operations in Southeast Asia. Costa's excellent performance was led by the UK, where profits increased by 26.5% to 110.9 million, with good performances in both retail and enterprises. Internationally, we made a small loss of 1.1 million, which again I will come back to. The profit improvement was driven by good revenue growth in both hotels and restaurants and in Costa. Hotels and restaurant sales were up 9.8%, with hotels up 13.4% and restaurants up 3.9%. Costa sales were up 20.1%, with UK sales up 19.6% and international sales up 24.3%. Of this sales growth, 4.2% came from the good like-for-like sales performance across our brands, with particularly strong fourth quarter. Premier Inn's like-for-like growth was 5%, led by the revenue per available room growth of 4.3%. And after a flat first half, the restaurant's like-for-like sales grew by 1.6% for the full year, with spend per head increasing by 2.5%. Costa's like-for-like, which I remind you is based on our UK equity business, was again exceptionally strong at plus 5.7%. It is worth touching on the shape to last year, which should be taken into consideration when looking forward. You can see how unusually cold weather in the first quarter impacted restaurants negatively and benefited Costa. You can also see that the fourth quarter sales were particularly strong in all businesses. In the fourth quarter, like-for-like sales growth was 7.2% compared to 3.3% across the previous 3 quarters. This was caused by a number of success factors that all aligned. Firstly, we had a very successful Christmas and New Year trading campaigns in all our brands. We also benefited from the benign weather comparatives in January and February, with unusually no snow for the majority of the country. This benefit was particularly evident in restaurants. We also enjoyed higher than expected profit flow through, especially in February, due to the strong average room rate growth in the hotel market, with higher profit conversion coming from room rate growth rather than occupancy growth. And in restaurants, we were able to significantly reduce promotional discounting in the fourth quarter, enabling us to enjoy better margins than expected. I would also point out that the year-on-year hotel and restaurant comparatives in the last quarter were softer, again, especially in restaurants. The good finish to the year resulted in significantly stronger second-half profits and a fourth quarter slightly better than we expected. This chart shows the first and second half profit split. Costa's profits were up 22.8% in the second half, slightly ahead of the first half, with hotels and restaurants' second half profit growth nearly double the first half at 15.6%. 50% of the better performance than we expected in the fourth quarter came through in restaurants due to the weather comparatives and the lower discounting. On the costs, I thought it would be helpful to highlight 2 categories that have not moved in line with sales. Firstly, rent. Property rent was £182 million, up 20.8%, with hotels and restaurants up 27% as we increased the mix of leaseholds in our estate. We expect hotels and restaurants rent to increase by around 20 million in 2014-15. Secondly, depreciation in hotels and restaurants was up 15.8% to just under 95 million. Again, this was ahead of sales as we aligned our fixture and fitting economic lives to our refurbishment cycle, accelerating £6 million of depreciation into both 2013-14 and 2014-15. Coming back to Costa International, we continue to invest for our future growth, and losses in the year were 1.1 million. We grew profit in our franchise business, particularly in Ireland and the Middle East, and in our like-for-like estate in China. Offsetting this, we continue to invest in our new stores, the infrastructure and team in China. In Poland, we have seen a decline in our profitability caused by a weak macro environment, an increase in VAT, and some disruption as we reviewed our estate and started to rebrand the stores from Coffee Heaven to Costa. We also invested in the start-up of our exciting new equity business in France. Looking further down the P&L, profit after tax and exceptional items was up 10.7% to 323 million. The key items after underlying profit are firstly, the IAS pension finance cost, which was 23.6 million. Secondly, the tax charge of 88 million. And lastly, exceptional items, which benefited the P&L by 25.9 million. Within the exceptional credit, there are three items that I would like to pull out. Firstly, we had 31.9 million of impairment and losses on disposal. A third of this relates to the reorganisation and re-energising of our Polish business, with a write-off of the Coffee Heaven brand and related assets as we rebrand to Costa, and the closure of 15 loss-making stores. Within impairment, there's also an additional provision of around 7 million for the revision of legacy Whitbread leases that are expected to return to the company. Secondly, there was an 18.6 million credit to the deferred tax due to the reduction in corporation tax rates to 20%. And lastly, there was a 40.2 million credit to the P&L, again in respect of deferred tax, following a reassessment of our estimates of the deferred tax-based costs on our property assets. Most of these exceptional items are non-cash items, and we have current expectations of around a £7 million cash outflow this year. Cash generation from operations was 601 million, up 14.3% on last year. This strong cash flow enabled us to fund our growth milestones from internal resources, as they will in the future, grow our dividends and reduce our debt in the year by 79.5 million to 391 million. Capital expenditure was 306 million, of which we spent 128 million on freehold property acquisition. Cash paid out in the year included 62 million in dividends, 90 million of interest, and 81 million of tax. We also contributed 71 million to the pension fund, which included payments under our triennial deficit payment agreement. Cash capital expenditure was 306 million. The accrued capital expenditure was significantly higher at 336 million due to a higher proportion of our hotel refurbishments being carried out in the last few periods and therefore not paid for at the year end. Expansionary cash expenditure was 200 million, and of this 148 million related to hotels and restaurants, supporting the new room and restaurant openings. And as mentioned earlier, 128 million was invested in freehold property compared to 134 million last year. Costa expansionary capital was 52 million. The spend was slightly lower than last year, principally due to the timing of the rollout of the Costa Express machines. 106 million of cash was spent on maintenance in the year, and as just mentioned, a further 30 million of maintenance and refurbishment was carried out in the year in hotels and restaurants that was due to be paid for after the year end. A key focus for us remains return on capital, where we have a significant premium to our cost of capital. Returns in the year increased by 1.4% to 15.3%, with improvements in both businesses. 0.6% of the group's improvement came from the higher mix of leases in our hotels and restaurant estate. One of our competitive advantages, particularly in the property market, is our strong balance sheet. Our finance objective is to manage our net debt to EBITDA to less than 3.5 times. I remind you that here the net debt is made up of our cash debt, our pension deficit, and an 8 times multiple of our leases. We finished the year with our net debt to EBITDA at 3 times, the calculation of which is laid out in the appendix. This would have been slightly higher at 3.1 times if we had not had the cash savings on the scrip dividend and if the high fourth quarter hotel refurbishments had all been paid for in the year. This balance sheet structure enables us to pursue our growth milestones with confidence, particularly as we increase the room opening rate over the next few years, and allows us to grow the freehold estate, our preferred property solution. Whitbread also remains well funded with a diverse range of sources. In the year, we successfully extended our £650 million bank facility from 2016 to 2018 on the same pricing. Pulling out a few other financial items to note, the deficit on our pension scheme reduced by £7 million in the year to £534 million, principally due to the performance of its assets and the cash contribution made by the company. This was partially offset by the high liabilities as a result of the reduction in the discount rate. The next triennial pension review will be based on March 2014 valuation and will conclude in mid-2015. We have decided to replace the scrip dividend with a dividend reinvestment plan, which will be offered on the final dividend payment. Earlier on, I said I would come back to our effective tax rate, which came in at 22.9%, compared to 25.7% last year. In the year, we benefited from, firstly, the lower standard corporation tax rate. Secondly, we received an ongoing benefit from the indexation of our property tax base cost of roughly 0.7%. And lastly, we had a one-off benefit of £4.7 million from adjustments in respect of the tax expense in previous years, benefiting our tax rate by 1.1%. The corporation tax rate reduces again this year, and we expect our effective tax rate to be around 22%. Looking forward to 2014-15, there are a couple of financial considerations that are worth pulling out. Firstly, we obviously had a strong second half, which makes our comparatives progressively tougher. On this page, from left to right, you can see the quarter-on-quarter Premier Inn occupancy, ARR, and RevPAR growth, which shows a strong fourth quarter following our especially successful Christmas and New Year, and the strong room rate growth in the hotel market in the second half. The first 2 months of this year have been good, and from the previous pages, you can see we are up against relatively soft comparatives in hotels and flat like-for-like growth in restaurants, which, as I had just said, get tougher in the second half. I'd also remind you that a significant part of our overperformance in the last quarter came through in restaurants, which particularly benefited from the benign weather. Andy will talk later about the investments we are making in our customer proposition. In the current year, we will be stepping up the refurbishment programme in hotels with around 12,700 rooms refurbished compared to 5,400 last year. We will be rejuvenating our restaurant brands and upgrading our Wi-Fi capability in our guests' rooms. We'll also be evolving our systems and processes to support our future growth, in particular around our digital and data capabilities. These additional investments will amount to around 10 million incremental P&L spend. And as mentioned earlier, we expect our hotel and restaurants lease costs to grow by around 20 million as the proportion of our leasehold estate increases. Due to these items, our own internal expectations, particularly this early in the year, are to maintain hotel and restaurant EBIT margins year on year. Looking at our growth drivers in the year, we are planning 4,500 new UK room openings and 300 new coffee shops, and forecast our capital cash expenditure to be approximately 360 million. This is particularly sensitive to the timing of transactions and opportunities that arise within the freehold market. So in summary, we are pleased with our financial performance in 2013. Whitbread is doing what it said it would do. It is delivering on the targeted milestones, and we're delivering good profit and earnings growth, which have increased by 16.5% and 21.1% respectively this year. The group generates good cash flow that allows us to fund the organic growth from internal resources, allows us to reinvest in our customer proposition, and supports this year's double-digit dividend growth. Whitbread is delivering a good return on capital, which the management are extremely focused on. And lastly, Whitbread has a strong balance sheet underpinned by well-funded facilities and a good freehold estate. I will now hand back to Andy, who will take us through our performance in more detail.
Okay, thank you, Nicholas. This is the agenda which I shall use for the rest of the presentation. As you know, Whitbread is a hugely people-intensive business with 43,000 UK employees aiming to make everyday experiences special for each and every one of the 22 million customers who visit every month our 2,800 UK outlets. By making everyday experiences special, we aim to consistently deliver a great experience for our guests who sleep in 15 million Premier Inn rooms every year, the 47 million people who eat in our restaurants, and the 400 million people worldwide who drink a cup of Costa every year. We use this customer heartbeat model to capture our business philosophy, and you'll see this image throughout the business, from the boardroom wall to the back of house in every single Whitbread operated site. It's backed up by clear, quantified metrics which have a consistent link from the win card, which is our KPI that we use at every single Whitbread site, right through to the monthly board report. One of the most important ingredients to a strong customer heartbeat is training and motivating our customer-facing teams. And we're particularly pleased to report a further strengthening of employee engagement, as measured by our biannual You'll Say opinion survey, with engagement rising to 80%, which is the target that we set ourselves to achieve 4 years ago when engagement was just 63%. And we continue to invest in employee training and apprenticeships, with our organic growth allowing us to create around 3,000 net new jobs last year. We also received excellent recognition as a top employer as we moved up the top 10 list for both the Sunday Times Best Big Companies to Work For and Britain's Top Employers survey. Looking forward, we're refreshing the way that we measure employee engagement, looking for ways to push the boundaries of our own performance and to set ourselves even tougher goals. Strong employee engagement helped us to deliver record guest scores, with our Net Promoter Scores moving ahead for all of our brands. As with employee engagement, we're also looking to refresh our customer performance measures. For example, we want to bring a stronger B2B focus to the measurement of Net Promoter Score in Premier Inn. And in restaurants, we want to use our loyalty cards as a customer feedback mechanism in the same way that we do with the Costa Coffee Club card. Our network expansion continues in both Costa and Premier Inn, both in the UK and in selected international markets. And this is just another step on the way towards hitting our 2016 and 2018 growth milestones. So Whitbread has now delivered 5 years of strong double-digit organic growth, with sales up 11% per annum over the last 5 years, EPS up 15% per annum, and dividends up 13% per annum. We've also improved our return on capital up to 15.3%. And this is just a brief reminder of the growth milestones which we've already published. There's still a huge amount to do, but we're on the right track to deliver. So let me turn now to Whitbread Hotels and Restaurants. WHR continues to create substantial shareholder value with good sales growth, up 9.8%, driving an increase in profits of 11.2%. Premier Inn continues to win market share through the combination of network expansion and good RevPAR growth, and our return on capital increased to 13.3%. Premier Inn International continues to progress in selected international markets. So let's look at Premier Inn in more detail. This is the schematic which we've used a number of times before, which illustrates the key pillars supporting Premier Inn's outstanding customer value and the main KPIs which we use to drive the business, and how these translate into value creation for our shareholders. And once again, I'm pleased to report good progress for all these metrics. Indeed, we've delivered new record performance on every single dimension. Our UK network of 672 hotels means that we offer customers a much better choice of location than any of our competitors, meaning that we can get more customers much closer to their chosen destination than any other UK hotel chain. And as you can see on the slide, the gap in terms of network choice has continued to widen over Travelodge. We now have 172 more locations than they do, an even bigger gap than the 134 2 years ago. Our customer satisfaction continues to improve from a very strong base. Our average TripAdvisor score is 4.3 out of 5, which is a tremendous average for 672 hotels. Our brand strength, as measured by YouGov, continues to grow, and our own guest satisfaction survey, with nearly 1 million respondents every year, also continues to improve. All this comes together to provide customers with tremendous value for money consistently across the UK. And you can see on the chart, we've once again widened the gap over our competitors. Customer expectations continue to grow, and it's important that we invest to stay ahead. That's why we invested £80 million last year in refurbishing and maintaining our estate. That's why we launched our Best Ever Bed campaign, and we will have installed 30,000 new beds by the end of this year. We're implementing our new structured refurbishment programme, and we're installing air conditioning into an additional 2,500 rooms this year, which means that we now have aircon in 55% of the estate. And we shall also be investing, as Nicholas said, to improve our Wi-Fi capability. By 2018, we expect to have substantially improved the quality of our estate, with 90% of our rooms having our latest ID3 and ID4 room designs, which is up from 60% today. The combined strength of the Premier Inn brand, our growing network, and consistently great value for money has allowed us to deliver a winning combination of room growth and consistent RevPAR growth. You can see that clearly on this slide. On the left, in the UK regions, we've grown our room stock by 7.7% per annum over the last 3 years, and our RevPAR by 2.2% per annum over the same period, clearly outpacing our competitive set on both dimensions. You can also see the reduction in RevPAR for the competitive set in 2012-13, reflecting Travelodge's financial difficulties. It's the same story for Greater London on the right-hand side of the chart, with the gap between Premier Inn and our competitive set being even greater in terms of both room growth and growth in RevPAR. As our occupancy increases year after year, there's a bigger opportunity to make selective rate increases using our dynamic pricing system. For instance, in the UK regions, we've recently increased our prices, especially for the higher occupancy nights in the high occupancy hotels. Similarly, in London, we've raised our price cap from £189 to £200. This slide also shows the dip in occupancy for the competitive set in 2012-13. So this is dynamic pricing in action. At the top, you can see absolute occupancy by day of the week, with the peak days being Tuesday, Wednesday and Saturday. On these days, you can see that RevPAR growth on the bottom half of the slide has been driven more by rate than by volume. The lowest occupancy days are Friday and Sunday, where we've maintained rate to grow occupancy. And also notice the high levels of absolute occupancy on every day of the week, apart from Sunday, which reinforces the opportunity with our organic growth plans. As we've said before, dynamic pricing is a journey which combines progress in developing our pricing principles, which work specifically for Premier Inn, building our in-house expert pricing team, and developing systems which will gradually automate what is still quite a manual process. I won't go through all the detail on this slide. The main point is that the journey is continuing with plenty of road ahead. One of Premier Inn's core strengths is the power of premierin.com, and you can see on the left the increasing percentage of reservations coming from customers who go direct to premierin.com. Linked with this, you can also see the decline of our non-automated telephone bookings. Equally, you can see that web indirect traffic, which is booking.com, has increased from 4% of reservations to 8% of reservations. This reflects the rapid changes in the competitive online landscape illustrated on the right of the chart, with the emergence of new online distribution channels, including the meta search companies and Google itself. We're investing heavily in our online marketing capability so that we can continue to grow the percentage of reservations direct to premierin.com. You will not be surprised that mobile is an increasing proportion of our business, which now accounts for 36% of all online visits, up from 22% a year ago. We've also launched new apps, which have helped to increase the conversion rate. So we now have a committed pipeline of around 11,500 rooms, of which just over 9,000 are scheduled to open before 2016. This means that we're on track to hit our 2016 growth milestone of around 65,000 Premier Inn UK rooms. In this financial year, we expect to open around 40 hotels, representing around 4,500 new rooms. London remains an important focus, where we have a committed pipeline of around 5,500 rooms. This, together with our existing estate, takes us to just over 14,000 rooms in London, well on the way to our ambitious goal to have around 20,000 rooms in London by 2018. On this slide, you can also see the increasing importance of central London, together with the growth of our hub pipeline. Our first hub by Premier Inn is due to open in St Martin's Lane in the autumn of this year, with the next two hotels opening in the summer of 2015. Altogether, we have 9 hotels in our committed pipeline, 7 in London and 2 in Edinburgh. So turning now to Premier Inn International, the business continues to make steady progress. The Middle East is doing well, helped by a stronger economy in the UAE. Here we're seeing good profit growth together with outstanding customer scores. India is a more challenging economy, but we're making progress, albeit limited and from a low base. We remain excited about Southeast Asia, and particularly Indonesia, where the pipeline is building very nicely. On the right-hand side of this chart, you can see the increasing importance of Southeast Asia, with 12 hotels in the committed pipeline and a further signed MOUs. On the left, you can see the growth of our capital light pipeline. So let's turn to restaurants. The shape of the year was significantly influenced by weather comparatives, with difficult comparatives in the first half and unusually favourable comparatives in the fourth quarter. Overall, we delivered a much stronger second half performance, which compensated for a challenging first half. For the year as a whole, sales were up 3.9%, with like-for-like sales up 1.6%, driven by spend per head. We outperformed the Coffer Peach industry tracker outside of the M25. In the second half, we outperformed by 1.4 percentage points. This competitive outperformance was helped by record guest scores and record employee engagement. Our mission in our restaurants business is serving up great memories. And this is our recipe for success, which is the framework that we use for training and motivating our teams. These simple but powerful communication tools are central to galvanising all 14,000 team members in delivering record guest scores. In terms of margins, the second half improvement offset the first half contraction. Throughout the year, we delivered nearly £3 million of labour productivity, together with savings from better menu management, and we've also substantially reduced the amount of promotional discounting which we aim to continue in the coming years. One of our key strategic thrusts is to build strong national brands, and we're working hard on rejuvenating both Brewers Fayre and Beefeater. On this slide, you can see how we're moving the Brewers Fayre brand from being a tag brand for the local pub on the left towards the new logo on the right, where Brewers Fayre becomes the primary branding and the local pub name the secondary brand. Just as importantly, we've invested substantially in food development, which has driven a step change in the quality of our food whilst maintaining excellent value for money. Beefeater is already a national brand, but was clearly in need of some rejuvenation. On the left, you can see the old Beefeater grill and the new branding on the right. The picture shows our observatory Beefeater in Leicestershire before and after the rebranding. Similarly, we worked hard on revitalising our food quality and customer choice in Beefeater. We're also modernising our interiors and making them more light and open. The initial results of the rebranding in both Beefeater and Brewers Fayre have been very encouraging, although it's too early to be talking specific numbers. Throughout this rebranding process, we focused our investment on the customer touchpoints, which directly impact the customer's experience, and we've consciously limited the investments in our buildings, which are generally in reasonably good shape. So for Brewers Fayre, we shall have rolled out the new branding across the estate by the end of this financial year, with an average investment of around £50,000 per site. The investment in the new Beefeater is larger, at around £200,000 per site, and we aim to have nearly 30 new Beefeaters operational by the end of the financial year. Turning to Costa, this is Tony Huang from Costa China, who was crowned Barista of the Year back in October 2013, symbolising both our coffee expertise and the increasingly international nature of our business. Many of you will have attended our recent Costa Investor Day in December, and there have been no substantive changes since then. There's certainly been no change in Costa's financial performance, and the business has delivered yet another excellent set of results, with system sales up 19.4% to £1.2 billion. We've opened another 334 net new stores worldwide, bringing the estate up to nearly 2,900 stores. And in addition, we've grown the Costa Express machine estate by 37%, and it now stands at 3,500 machines. This strong organic growth, combined with good like-for-like sales, drove a 21.9% increase in profit to nearly £110 million, together with return on capital up to over 40%. Once again, we have seen double-digit growth in system sales in every division. We've continued to extend our market-leading position in the UK, growing our store network to 1,755 stores, well ahead of our competition, further increasing our market share, which now stands at 12% of the UK coffee shop market. Still plenty of room for further growth. On the right, you can see that Costa continues to extend its lead as the UK's favourite coffee shop, which underpins both our like-for-like growth and our continuing store expansion. The UK coffee shop market continues to grow, driven by the fundamental socio-economic and demographic changes which we described at the Investor Day, which have helped Costa to benefit from the changing shape of the UK high street. The forecast on the left-hand side of the chart was updated by Allegra just after our Investor Day and projects market growth in volume terms of around 4% per annum. On the right-hand side, you can see that coffee consumption per capita in the UK remains relatively low compared to many other major European countries and compared to the US. This suggests that there's room for further growth in the UK coffee market. So, as we've said before, we expect to grow our UK estate to over 2,200 stores by 2018 and across a range of locations as shown on the right-hand side. Our like-for-like growth continues to be driven by transactions, with a 5% growth in same-store transactions last year. Of course, we can only achieve this by winning more customers, which in turn is driven by product innovation, by our great baristas, our ongoing programme of store refurbishment, which have all combined to improve our net promoter score by 7 percentage points during the year, backing up Costa's increased brand preference lead over our competitors. The picture shows some of the new products that we've introduced recently. Costa Express had a fantastic year, adding 955 new machines, bringing the estate to over 3,500. We expect to add another 600 machines in this financial year, and we're exploring new market sectors in the UK, as well as some new international markets. We expect our international estate to grow to around 1,850 stores by 2018, with perhaps 500 to 600 new equity stores and 250 to 300 new franchise stores. And our international franchise business continues to grow nicely, with good numbers in the Middle East and Ireland and new market entries in Spain and Morocco. So turning to our European equity business, the rebranding of our Polish business is well underway, and we have around 20 stores open in the new Costa brand, and we will assess their trading performance over the coming months before rolling out the rebranding programme. Early signs look positive. In France, we now have 4 equity stores open in Paris, in addition to our 2 franchise stores at the Gare de Lyon and Nice airport. This is a little slower than we expected as we learn about the vagaries of the French property market and French regulation. Early trading has been encouraging, and we aim to open the next tranche of 5 stores before the end of the year. Our business in China continues to progress, with like-for-like growth in high single digits. We remain very excited by the medium-term opportunity in China, and we continue to invest in building our own management capability and the resources required to drive growth, including property, operational leadership, supply chain and logistics, together with social media and marketing. Good Together is our CSR programme, and it's an important and integral part of our business philosophy. We know that our people want to be part of a company which is giving something back to their communities, and our Good Together programme helps to support our high levels of employee engagement. We've committed to raise £7.5 million for a new Premier Inn clinical wing at Great Ormond Street Hospital, and we've already raised over £2.2 million in just 22 months. The Costa Foundation continues to do great work, and last year we raised £1.5 million and completed 8 school projects in coffee-growing communities, adding to the 32 that were already completed. We've created around 3,000 new jobs in the last financial year, and we continue to invest heavily in training and apprenticeships. We have a particular emphasis on helping young people, and often the long-term unemployed, helping them to get back into work. So, turning to current trading, we've had a good start to the new financial year, although please remember that we are up against relatively easy comparatives in Q1 and Q2, which we expect to become tougher as we move into the second half. We also continue to invest in improving our customer experience, which will help to support our like-for-like growth well into the future. And we believe that our investments in selected international markets will be a source of longer-term profit growth. So in summary, 2013-14 was another record year for Whitbread, with strong double-digit financial growth driven by record customer and employee engagement scores, which have helped to underpin our strong like-for-like growth. Our strong brands continue to get stronger and to win market share, which delivers excellent financial returns and the finances for our ambitious organic growth programme, as well as the strong growth in our dividend. The new financial year has started well, and we look forward to another good year. So I and the team will do our best, as always, to answer any questions that you may have. Just one at a time, Lady Vicky. Ladies first. If you could introduce yourself and your organisation, that will help everybody else.
Yeah, morning. Hi, it's Vicky Stern from Barclays. Just a few questions on Costa, actually. Firstly, on Costa Express, wondered how the trials of the new machine are going in the workplace, and just when you think you might have more visibility on a potential rollout, particularly on the workplace in the UK. Second question is around Costa International. That made a loss this year. Just curious how we should think about the evolution of that line over the next few years. And I guess in that context, when we might have visibility on a sort of bigger rollout in France, when you might make that decision. And then finally, just around pricing in the UK, there's still no plans to increase prices in the UK on coffee, despite the actions of your competitors. Thanks.
Chris, why don't you give Nicholas a turn and do the projected losses, and maybe you can handle the other two. Yeah. Yeah. Don't. Yeah.
Morning, everybody. Vicky, in terms of the express machines, the new express machines, we've got about 50 out in the field at the moment, and we're going to be continuing to look at them for a few months yet. I think come the year end, we'll give you a much better line of sight on that. On pricing in the stores, we have no plans in the short term to raise prices, but I would hark back to the point I made in December, and that is we are very comfortable with the margins we're making. So any price work we did would be to reinvest back for our customers. Nicholas. Oh, well, on France, we got 4 stores trading. We are going to open at least another half dozen in the next 6 months. And I think we will look at those for the rest of the year and then give you an update as to how quickly we might roll from there.
Yeah, in terms of looking forward, as you say, we made a loss of just about £1.1 million this year on Costa International, and we made good progress on the franchises and like-for-like estate. We've got a lot still to do, a lot still to invest for, and I guess the kind of immediate thing is to actually make sure we're growing the platform for growth rather than kind of trying to move to profit. And I guess there we're still looking to reinvigorate our estate in Poland, so a lot of work to do there. We're still growing the infrastructure around China, and then we're still investing in the expansion of our French business there. So we expect to see some improvement, but not considerable this year. But we're still looking forward to making material profits in 2018, as we said at the Costa Investor Day.
Thanks. Good morning. It's Tim Ramskill from Credit Suisse. Couple of hotel questions, please. So, Nicholas, in your comments, you were very specific about the outlook for margins being sort of close to flat for the year. Clearly, that's going to depend somewhat on the trading environment and the RevPAR, and in particular, the pricing components. I just wondered if you could give some colour around how you guys think about that in setting that message. And then the second question is really about the UK hotel supply outlook. Clearly, one of the charts showed that there has been a beneficial dynamic in the market with less supply growth more recently. Maybe Patrick can comment on your expectations for the supply environment amongst your competitors in the next 12 to 24 months.
Yeah, so I mean, in terms of we've got some. It was pulling out some of the cost impacts that we had. We had the higher rent this year, and then also the fact that we're making some investments in our room and our hotel refurbishments and investing in some of our technology and processes, which kind of led to the comment about flat margins year on year. You're right there. It depends on what RevPAR you're assuming in there that's driving that overall. We're not going to tell you what our guidance is, but I guess in terms of give you some kind of what's out there externally, if you look at the kind of STR forecast at the moment for RevPAR, it's just about below 4%. And if you look at consensus, top end of consensus on RevPAR is around about 5%. So in between those two figures, we feel is fairly sensible and comfortable with.
Yeah, thanks, Tim. On supply, I mean, overall, we're seeing a slight drop in independence year on year, just dropping down a little bit. Particularly as we go into some of the regional areas where they are, we're just seeing a little bit of sort of a shortening of their room stock. Competitors maybe not quite so active as you could expect. One of our main competitors probably not quite able to get the funding that they require to do new sites, and we're taking every opportunity to go after any site that comes up that we can compete aggressively on. In London, that's our key focus, really working hard to get as many sites as we can in London, but good quality sites. As you saw, probably we've increased our pipeline from 10,000 to 11,500 rooms, so we've managed to increase our pipeline going forward. That's our real focus.
Thanks. Jeff Collier from Deutsche. 3 questions, one for each division. Patrick, on the in the hotel front, over the next 3 or 4 years, you're looking to expand massively the London portfolio, which looks like it'll end up being about a quarter of the rooms in the portfolio by the end of the schedule. How much do you think you'll be relying on Booking.com for international travellers to fill those rooms, i.e. it's currently 8% of rooms booked. How far do you think that's going to go? And can you give us any indication on the sort of fees you're paying? I presume they're not that high. Secondly, for Paul, on the restaurant front, one of the problems that restaurants have had has been lack of London exposure. As the UK economy starts to come out of the slump, do you expect your lack of, or your relative underperformance compared with the market to flatten out? And then thirdly, Chris, can you give us an idea about where you think the 500 to 600 international equity shops are going to be built on the Costa front? Thanks.
Okay.
So on PremierInn.com and Booking.com, I mean, as Andy said, our real desire is to try and drive as much traffic as we can to PremierInn.com. And we launched about 3 or 4 weeks ago 4 international websites. So we've now got PremierInn.com in France, Spain, Italy and Germany. We've also introduced quite aggressive PPC for branded search in those countries. We've also done PPC branded search in all English-speaking countries. So we're looking to try and take as much international traffic direct to us as well. That's something quite new to us. And likewise on Google, the web is getting quite complicated now, but on Google, we've managed now load all our customer data onto Google search terms, which makes it more relevant, which means now we appear on search terms ahead of people like TripAdvisor. So we're really putting a lot of work into this area, employing some good people, good backgrounds into that to really try and manage our digital capability. And our intention really is to drive more into PremierInn.com, less into things like Booking.com, and come out as much affiliate programs as we can.
Thanks, Patrick. Hi, Jeff. In terms of, you're quite right, we haven't got any sites in London, and clearly the London market has done much better over the last couple of years than the provincial market. That's why we measure all our market data against the outside the M25 in terms of Peach Tracker, and as you can see, we've overperformed that considerably in the last 6 months and pretty consistently over the last 3 years. There's no plans to have greater London presence. We're going to grow through joint sites, and we expect the provincial market to do a bit better going forward than it's done in the last couple of years, and we expect to continually to outperform it.
Chris?
I'd expect 300 to 400 of those to be in China, the balance to be in France and Poland, and I wouldn't dismiss us being in another territory.
Okay. Any more questions? One down here, Jason.
Thanks. Morning, Jamie Rollo from Morgan Stanley. 3 questions, please, on hotels. That £10 million of revenue investment you referred to, is that going to continue beyond the current financial year, or could it go up or go down? Secondly, what sort of return do you expect on this CapEx, whether that's a sort of RevPAR premium or sort of like-for-like kicker, if you can just give us some feeling for what you might get as the product goes materially higher than the peers. And then finally, you referred to a big rate increase at the end of the year in February. Looking at the sort of quarterly ADR figures, it looks like you had more of a rate increase in Q3 than Q4, so maybe it was right at the end of the quarter, but what sort of rate increase in general did you actually put through in that month?
You know, with dynamic pricing, we've got lots of different prices, and really what I've said is we moved the prices in the regions in the high occupancy hotels on the high occupancy nights, and we moved some of the mid to top end prices by £5 to £8. You cannot see that in the numbers, and it takes about 4 to 6 weeks for that to come through. So I think it's going to be more of a sort of Q1 effect of this year than a Q4 effect of last year. In terms of what return will we get by improving the product, very hard to put any numbers around that. We think it will just underpin our rate growth over the coming years. And Nicholas, 10 million?
In terms of £10 million, I mean, it's a lot of it is due to kind of step up in our refurbishment programme, which continues as well, and the re-energising of rejuvenating of our restaurant, which continues as well.
So just on the rate increase, so what is the blended? I know there's lots of different markets and stuff, but what is the blended effect of that? You've obviously seen the numbers.
It's really hard to work out, Jamie, because what's happening is all the prices are changing all of the time, and the market conditions are changing all the time, and the competitors are changing their prices. So the reason why we've done it, as you can see, we start this financial year with a higher level of occupancy than we did the last financial year, and therefore we've tried to look very cleverly at where we can push rate and still maintain great value for money scores. That's a question there.
Good morning. Thank you. It's Jared Castle from UBS. Just three questions. Firstly, just coming back to the Costa international losses, can you say anything about what's actually happening at the operating level in Poland, and whether, I guess, the Polish experience has made you, I mean, you are very cautious when it comes to, I guess, acquisitions, but, would you still consider maybe bolt-ons going forward? Secondly, just in terms of, I guess, partners for Costa Coffee, such as you announced yesterday in Spain, do you generally kind of look for them, or do they generally approach you and then you kind of expand markets or go into new markets? And then lastly, just one on kind of hotels. You've kind of given different distribution modes, Google, Priceline, etc. One you haven't mentioned is Airbnb. Clearly they did a capital raising a couple of weeks ago, seem to be growing quite quickly. Is that a concern at all, Airbnb and those models? Thanks.
The last question is the easiest one. Not particularly. There's a whole load of competition, and as I said, the online landscape is changing really quite rapidly. Airbnb is just one of the new players that are there. I think, Chris, in terms of Poland, maybe just one comment for me. If we look back at the Coffee Heaven acquisition, I think one of the lessons we've learned is we should have done the rebranding earlier. The business performed actually reasonably well in the first couple of years. Then it hit much tougher macroeconomic conditions. And I think if we had our time again, we would have got on with the rebranding process a bit earlier. But Chris is more of an expert than I.
You asked the question about partners. We actually have a huge database. Lots of people keep writing in saying they'd like to be our partners. On the specifics of Spain, we've actually taken two existing franchise partners, one from Malta and one from the Channel Islands, and given them two territories in Spain. It's the first time we've done that, but it has the great advantage. They know the brand, they know what they need to do, they've got experience, they've got a track record, and I think it's a very interesting combination for us. On Poland, the major issue in Poland had been a decline in transactions driven by the tough macroeconomic situation and also the ageing of our estate. I think as well as not rebranding it, we hadn't actually refurbished it either. And I think those two things together help explain some of the performance.
Yeah.
Morning, Tim Barrett from Nomura. Two things on hotels, please. Could you give the estimated split of leasehold openings in the 4,500 this year and indeed in the pipeline? And then just a quick question on Q4, that rate issue we've been talking about. It looked to me that rates were up around 4% in the fourth quarter. Is your message there that based on the moves you've made, this year should be that or better than 4%?
The fourth quarter is always the most difficult one to draw any conclusions from because it's hugely influenced by a number of specific things. First of all, snow, or the absence of snow, or the timing of snow. That can have quite a big impact. Secondly, we've said before that Christmas and New Year are really quite different trading periods. And whenever we do the pricing and the promotion for those two periods, we never quite know whether we're going to get it absolutely right or a little bit off. In the last year, I think we got both of them more or less spot on. So I think it's really quite hard to sort of disentangle if you like, the unusual aspects from what is also our quietest trading period, and then draw any conclusions from it.
Leasehold's about 70% leasehold
Yeah.
next year and in the plan.
Yeah. Question there.
It's James Hollins from Investec. Just three. First, a very quick one. The cash pension payment in full year 15, if you can give guidance on that, if you would remind me, getting 71 million in the year just gone. And then two on the international hotels. The first one is, are you being quite aggressive or having to be quite aggressive on minimum revenue guarantees in order to get new business Middle East? And obviously you're doing a decent job in Southeast Asia on getting new agreements there. And the third one on international, losses have been around 6 million now for 2 years. Can you just give some guidance on whether we should expect the same or whether that starts to come down in full year 15?
Okay, let me just start from the end. I'll repeat what we've said before in terms of our international losses. By 2018, we expect to get Premier Inn International into a profit. We expect to make a good return on capital on the mature hotels. So I think one can then sort of draw some conclusions between where we are now and where we think we will be then. It's very much a business that requires some scale. We're investing significantly in hotel development. In terms of minimum income guarantees, we have signed a couple of agreements which have got some guarantees in them, and we do that in circumstances where there's really quite a high property cost, and maybe we're looking at an alternative, buying the freehold, doing a leasehold, doing a management agreement, or doing a management agreement with some support behind it. And it's very much an individual specific decision with very specific negotiations.
And the pension payments for this year will be about 75 million.
Yes, Geoffrey Harwood from Oriel. Just one question on Premier Inn. Last year there was some discussion on the possibility of expanding into Germany. I just wondered if you could give us some update on that, please.
Yeah, we're still looking at Germany. Prima facie, it's a very interesting market. We think the Premier Inn product will work there. Having said that, we are looking very carefully at the differences between the UK and Germany, the different behaviour of German consumers, the different distribution channels that there are in Germany, particularly the differences in online distribution, quite a different competitive set, quite different demand drivers. So we're really taking our time to understand those differences really carefully, particularly from a customer point of view. And what you saw us do with Hub by Premier Inn was really do our homework on developing a product and thinking very hard about what the customer reaction would be. So that's just simply saying, a long way of saying, we haven't decided yet. And I think it will take us a few more months before we reach a conclusion. There's a question right behind you at the back there.
Nigel Hicks from Agency Partners. A couple of questions on restaurants. Can I just ask whether the reduced discounting and promotion was a policy decision or a change, or was it just because of strong trade so you didn't need to do it? Secondly, could you talk about the returns you're looking on the restaurant spend? It looks about sort of 7 or 8 million on Brewers Fare, and I'm not sure whether you're going to do all of the beef eaters and when by, but that's another sort of 24, 25 million. And on Premier Inn, on the TripAdvisor scores, are there hotels that are consistently sort of low, and are they the ones that you're then doing first on refurbs? Are you sort of responding to TripAdvisor on how you're timing your refurbs?
Paul, and then Patrick.
Hi, Nigel. In terms of reduced discounting, really a couple of things to think about. One, clearly, much stronger trading in the second half, especially the last quarter, which clearly does allow you to reduce your discounting. But probably the bigger factor is our loyalty schemes, and now we've got over 1 million people on our loyalty scheme. That allows us to be much smarter in how we communicate to our frequent customers and give different offers depending on their level of frequency. So that's probably the bigger driver. In terms of the two brand revitalisation programmes, I think what's really important, if you take Brewers Fair, which is about £50,000 per site, I think it's really important to put in context what we're doing on food and people as well as what we're doing on the physical environment. So Andy showed some really great pictures in terms of what's actually happened on our food, and we've had some really strong service programmes as well to improve the service within Brewers Fair. In terms of £50,000, most of that's gone on rebranding the chef's counters, which again really shows off the food for our theme nights on Brewers Fair, and really starting to put Brewers Fair as a national brand out there, so really dialing up our signage. And at £50,000, that's allowing us to go fast because it's very small capex. In terms of Beefeater, that's a programme we'll go much slower on. Again, don't forget putting food and people at the heart of that proposition. And again, Andy showed exactly how much we've done on menu development there, which is crucial for our Beefeater customers. It's slightly larger capex, around 200,000, partly because the buildings have been touched for quite a while and because the brand needed pushing further forward than perhaps the Brewers Fair revitalisation. But again, we'll go a bit slower because it's £200,000 per site, and we'll do about 20 this year. And assuming the success we'll get out of that will depend on the pace of that rollout.
TripAdvisor?
On TripAdvisor, yes, of course, we do look at TripAdvisor. We've got an average score between 4.3 and 4.5 across the estate. We do monitor that very carefully. In terms of the refurb, yes, we'll look at TripAdvisor, but more so we look at our own customer data. We have over 1 million responses a year, which gives us far greater clarity around it. And really what we're trying to do, as you saw on the slide, is deal with any ID2 or ID1 rooms, not that we've got many ID1 rooms left, and also the old Premier Lodge estate, which we now want to tackle. So that's how we go about it. So we're looking at those sort of 20,000 rooms we've got in Premier Lodge, ID1, ID2, then look at our guest data and then doing it in that way.
Just conscious of time, your time, and maybe one last question, but we'll all be around over coffee for any subsequent questions. In fairness, I need to put it over here to my right. But as I say, we'll all be around afterwards over coffee and happy to answer any questions then.
One last 3 questions, if I can. It's Wyn Ellis from Numis. First of all, on Premier Inn, how do you think demand is being driven? What's the difference, do you think, between the corporate market and the leisure market for you right now, and what are the dynamics there? Secondly, for Premier Inn and Costa, what do you think the underlying cost inflation is for the two businesses? And then finally, on the dividend, where you're moving from a scrip to a drip, what do you think the cash flow impact of that will be, and why are you doing that change?
Do you want to do the last two, Nicholas?
So just going from a scrip to a drip, this year we had a very strong take-up of the scrip, so 41% take-up. So there was a £44 million cash saving because of the scrip this year. So you'd expect that to reverse in the year. And the reason we've got a strong balance sheet at the moment, and we're not. This avoids kind of diluting our shareholders as well further. So that's the kind of reason for doing it. In terms of cost inflation, kind of across our businesses, we look. Labour cost inflation is around about 2 to 3%, and you kind of get food inflation could be around about 3% overall.
Just one additional point on the script. One of the issues with it was unpredictable. Many years we had very little take-up. Last year, because of the way the share price moved, we suddenly had a big take-up. So it was actually almost a random small issue of shares. Patrick, demand drivers, business, leisure?
Yeah, it's interesting. If you look over the year, actually, we've seen both midweek and weekend RevPAR occupancy and rate, both positive in both midweek and weekend. And I think the real drivers on the leisure, there's no doubt that the work we've done around our advertising, so we've stepped up our advertising campaign, probably double that what we were doing a year ago. So we're on TV most weeks, all feature spots on TV, really driving that. We're spending just over £1 million a month on that, so that's really driving volume to our website. I think the activity that we're doing, particularly on leisure, around how we use the web these days, as I was talking about, SEO maximization, PPC, we've really upweighted that capability. And on the business side, business account this year was £250 million worth of revenue. It was up about 14% year on year. We've got 25,000 active accounts now on business account. And and we're getting much better at looking after those sort of SMEs that are driving that midweek business. A few years ago, we started working with some big companies. I think we talked about having about 20 big companies. We've now got 61 major corporates that are spending over £500,000 a year. So our national sales force really targeting those companies. So really active in both areas. And we're seeing that occupancy and rate come through both midweek and weekend.
Okay, well, look, thank you very much for your time. As I said before, we'll be around over coffee if you have any more questions. Thank you.